Good afternoon, dear students, alumni, and guests. My name is Professor Grażyna Rembielak, and on behalf of Warsaw University of Technology Business School, I would like to welcome you very warmly to today's inspirational lecture. I want to welcome students and alumni of our university, Warsaw University of Technology, and in particular, Business School, our partners and our guests, especially from the university from Salford in Manchester, Sheffield Hallam University, Polimi Graduate School of Management, Politecnico di Milano, Goa Management Institute from India, Baltic Management Institute in Vilnius and Brussels, HEC in Paris, the Management Center in Innsbruck, Zicklin School of Business, Baruch College, New York City University, and the University of Minho in Portugal. Today, the inspirational lecture will be delivered by Mr. Andre Mierzwa, who is representing our school. Andre is the managing partner of 21 Concordia, which is a private equity fund investing in Polish private companies. And he's a lecturer on executive MBA and MBA programs at our schools. The topic he's delivering today is the human factor, how to strike a mutually beneficial deal with a financial investor. This is our last inspirational lecture in this academic year. I would like to take this opportunity to invite you to the next series of inspirational lectures next year. You will get our invitations after the summer break. Now I want to wish you a good time with Mr. Andre Mierzwa. After the lecture, you will be invited to ask questions on chat. Andre, you are more than welcome to start your lecture.
Thank you, Grażyna. Thank you for this introduction, and thank you very much for your kind invitation to deliver this inspirational lecture. And thank you all for being here, for finding time. In this presentation, I would like to draw on my 30 years experience, first as an investment banker, then as a private equity fund manager, as Grażyna mentioned. Let me attest before we start for one very simple truth. While the Excel and PowerPoints may have changed the way how we communicate, they have not changed the way how we evaluate the risk and how we make business decisions. This is still the human factor, what I call, and that's what this lecture is going to about. How to put together the process, the idea, the project with good valuation and making a good transaction that will actually not only survive the test of time, but also will lead to building a successful company. Let's maybe start with a very simple review of why companies need external financing. There are four sorts of. First, the companies that start up or look for initial investment has the highest level of risk. For startups or seed companies, there is very few or very often no benchmarks available for investors to judge the business. There is a new team, new product, new service, nascent market, new technology, really uncharted technology. In case of a bigger business, organic growth, you usually have a stable market, stable product, a specific service, competitive situation, a scalable growth rate, potential economy of scale. There you have benchmarks on the market, on similar businesses. When you look for growth for consolidation, via consolidation, it's even better because you have a build-up opportunity in growing or stable market. There will be definitely a premium for economy of scale. There might be opportunity for talent poaching and competitive position improvement. Therefore, the data will be very widely available. Finally, restructuring of the business turnaround due to market or internal problems when only additional financing can save the company, or help existing investors to save or maximize their proceeds. While you may have information available, you will need good expert advice for such a transaction to happen and be successful. Now, where is money coming from for these four kinds of deals? For startups and seeds, it's usually investors club, incubators, or venture capital players. More and more of those, the latter ones we see in the markets these days. For organic growth of the business, it's usually the banks, again, venture capital, some private equity, and why not, new connect markets on stock exchanges of the world. Growth via consolidation is more where we come in. The private equity, sometimes we may compete with stock exchange, and I will do this comparison later. Restructuring, it's definitely savvy private equity, might be mezzanine, might be also some bank financing, again, with strong expertise, advisor support. Now, what are the strings attached? If you're a business person of a company at different stages of development, you have to compare the pros and cons. In my experience, very often when I look for businesses, whether we should finance them or not, entrepreneurs come to us and they say, look, I have a business of that size. I can sell it today to a strategic investor. I'm 45 years old. I can happily retire, play golf. But to start another business and to make the same kind of success, it will be difficult. To which my response is, well, then instead of selling to strategic, consider selling to private equity fund. We'll help you to even grow the business for another 5-7 years. And in 5-7 years, two things will happen. Number one, you will sell for much higher price. Number two, you will be much closer to retirement, so you will not need to think about starting a new business again. Now, if you really compare the long-term debt, IPO and PE, I just listed on the page the most important things which are pro or con, but really from the investors or entrepreneurs' viewpoint, the most important thing is how much control of the business you will share and how much information you have to provide. Long-term debt, it's simple. You keep control of your business and the information you provide to a bank is confidential, stays with the bank. Nobody else learns it, gets it. But if the business does not perform to the terms of the loan, then the banker will have an upper hand. In case of IPO, you may keep the control, but you have to be prepared for the fact that you will not control the stock price of your company. You will open the newspaper every day and you will discover how the market values it. Okay, you can live with this, but most stock exchanges have very stringent regulations concerning information you release. That means whatever you do in the company, your competitors will know. So there goes the confidentiality of doing business. Private equity is in the way best of all three. We come in, you run the show, you control the business. The information you share with us remains confidential. We are like you, we partners, we protect the business. If the delivery targets are not met, then we have it in our agreement, shareholders agreement, or a share purchase agreement. What shall we do together to improve the standing on the way the company develops? And I'll come back to this in more details. Okay, the quickly types of private equity. What I would like to do here is I would like to concentrate on growth capital because that's what I do. So basically the companies who are well established, have good cash flow, and they look for growth either by adding new products and new services or in competitive markets, consolidate, i.e. buy smaller competitors, smaller operators to grow the size of the business, to use the economy of scale. Now, the value in this case is generated by the good entry price. I'll come back to that. Possible organizational and a managerial improvement of the company, and then the growth through expansion. Leverage buyouts and other types like management buyouts and distress investments are different kind of animals, which I will not comment on in this case. Now, the important thing in private equity is creating value. Any PE manager will tell you. It's the growth EBITDA, it's providing high returns. Now, what I'll try to show in this presentation, it's two things. Number one, private equity should never replace the management in trying to run, to steer the business. We're there to help, to monitor, to improve, to coach, but we're not there to tell you how to do the business, because this is not our responsibility. There are other ways how we can help, and we'll come back to it later. Now, what if a financial investor can or will do? Saying that a private equity investor, like my fund, is a financial investor. We can provide operational support. It's very important, especially in case of smaller companies. Family-owned or started by two partners. These businesses very often lack the back office support, the institutionalized framework, how the business should operate before it starts to grow. As we operate other companies, we usually have also, each of us has experience. In my case, it was investment strategy consulting before, then M&A. So we can advise our portfolio companies how to improve their internal work. It's not always easy, and I'll come back to it. People sometimes think that we over-structurize, that we are too formal. But in fact, when your business starts really growing, there's really no time to start putting structures in place, because if you do not have them, you will simply grow without any plan. Now, financial support, of course, we provide equity, capital. Very often we attract leverage, banking financing. But we also help to set up a good, transparent financial reporting system, which is very important for us as investors, but it's also important for other owners, for managers, and for financial institutions like bankers. We will not create the company strategy, but we will be a sounding board. If you as an entrepreneur create it, we'll help you how to adapt it, how to improve it. We'll help you in guiding your choice of growth option, how you should grow your company. And from the very beginning, we are there for 5 to 7 years, not for eternity. So from the very beginning, we will prepare your company for our exit. You may make a decision whether you want to exit with us or not. Again, I'll come back to that point later. My personal lessons learned in 10 years of running private equity fund. When starting my first fund, most investors were afraid the former investment banker will be very transaction-centered or oriented. As you know, M&A business is success fee based, rather than value creation, which is what asset management or capital growth requires. And in fact, I can tell it today, my M&A experience actually helped me in two respects. First of all, it helped me to assist the management of portfolio companies in acquisitions and add-ons. Because if there is one thing that private equity teams do very well, is we actually spend life buying businesses and negotiating the terms, how to do a good transaction. So when I tell my company, tell me whom you would like to buy, give me the basic KPIs, what I should look for, and your job will be, if I've done my job well, i.e. I did a good acquisition, your job will be to put the two businesses together. Now, second, my M&A experience actually helped me a lot in designing and executing exits from transaction. So when I even buy the company, as I said before, we already look who might be interested in buying this company again from us in 5-7 years. Will this be a strategic investor? Will this be another much bigger private equity fund who will look to consolidate the business beyond Poland's borders, maybe in Central Europe, maybe even a larger scale? Or will there be a possibility to do a good and successful IPO? But doing this, especially in the two latter cases, is to make certain that no stakeholder is forgotten and no advisor is left dragging on with the transaction. And again, we'll comment on this in a second. Third, much smaller point, before I started my job as an investment banker, I also used to work as a headhunter. And I must say that what I've learned about picking up managers and coaching them to the job is probably or was the best training and gave me the best tools to actually judge people in business. Now, let's put things in certain perspective. Let's try to understand all interests. As I said, you have three specific groups. You have owners, managers, and investors. And let's consider them in that order. Owners, it may be a founder, but it may be also his or her family. Very often, if you do not understand or underjudge the role of family in a family-run or operated business, it's frankly, may end up quite in a disaster. Also, you have to consider the representatives on the supervisory board or on the management board if they are there. You must also consider business partners. Very often people do business with a specific company because they simply trust the business owner and the CEO. If he's replaced by somebody else, some business partners may simply vote with their feet. They may leave. And all other stakeholders that will be interested in the value of the company and the future resale. Now, the management might be the founders' partners who see the place in developing the company for even a longer time. Might be members of the family who are waiting for the family managerial transition. Key managers, key employees, and also key advisors, and all other stakeholders that are interested in continuity of the business. Remember, I said we as an investor come in for 5 to 7 years. We buy into the company, we leave hopefully a better company, but all others are staying there in the company. We kind of sell them again. So we have to really take care of their long-term interests and the stake. Now, an entrepreneur, what does he or she want from a good transaction? Well, first of all, we come with capital, which is much easier to get in a way than the bank loan, has much less strings attached than a bank loan and an IPO. But he may also be looking at the same time as he accepts the capital increase, or she, to look for partial share of his or her shares, because this is a good opportunity to unlock the value of a liquid shares of the company that the person, the entrepreneur, built, and which the company may be depository of all personal assets, which is very often the case in Poland and other Central European countries. You know, the houses, the cars, and other expenses may be built at the company. So suddenly all this becomes transparent. And this is a good moment to say, good, I own 100%. You do the increase. I would like to sell 10, 20% of what I have for real cash. But you have to be very careful, because if you pay too much cash when you enter the company, then you automatically demotivate the entrepreneur, the business owners, or the managers, if they have the stake, to work harder to multiply your money, your fresh money that you just put in the company. Now, usually an entrepreneur will also seek to keep the operational control of the company. Now, that is one thing that must be rock solid written in the SPA, share purchase agreement, and SA, shareholders agreement, to avoid any future battles, because who controls what, who can influence changes if, for instance, the budget is not met or company falls on hard times. Because any of these things within 5 to 7 year time span might be simply detrimental to the value of the company, detrimental to the value of the business that you invested in. And the last thing, where the private equity investor must be very open to the owner and transparent, is whether the entrepreneur, he or she, will agree to sell his stake when the fund sells to a strategic investor. You know, usually strategic investors, they buy 100% of the business because they want to put their management, their systems of running the business. At the best, they will offer the manager, the owner, to become a member of the supervisory board. But if we sell the business to another private equity fund, or we do an IPO, initial public offering or stock exchange listing, then of course the owner and the key manager must stay in place because they will be the guarants that the company, without our support, will continue developing. Finally, what do we want as an investor? Well, simple, well-researched and tested business model, 3 years of track record, good annual budget, 3 years value creation plan, hopefully 5 years strategic vision of the firm. Strong and well-motivated management team that is prepared and will carry out the above plan. Now, if the management team includes owners, a clear definition of the role in running the business, possible transition plans, family or movements to the supervisory board, as I mentioned before, and finally, a very clear exit strategy. Who will buy the company when our value creation plan is successful? Now, just to give you a brief glimpse, this is what we call the selection process. It can be complex. When you look at stage one, I could say that we're looking at about 100, 150 opportunities a year. Stage two, looking at strategy, we'll probably draw the number down to 15, tops 20. And then step 3 and 4 and 5 will end up probably throughout the life of the fund. Investment period is 5 years. If we invest into 8 to 10 businesses, that's all. So it's very rigorous selection process. Now, even if you look at it from the point of view investment committee, it gets even more detailed. The screening, the internal due diligence, the full due diligence with advisors, and I will comment on this later, the structuring of the transaction, and then the investment itself. It really, on one hand, it's very venture-oriented and challenging process. On the other hand, we really have lots of boxes to tick in. So it's a very rigorous process. That's what investors are looking for. Now, why it makes sense to have advisors in this process? Well, first of all, if I have an advisor, an entrepreneur has an advisor, we have a common playing field. Both sides understand what's going on, and the advisor will help to drive the transaction to the end. In case of the market information, a good advisor will always provide you outside information that I, as a fund or entrepreneur, as a business owner, doesn't have. And that information will allow us to put the map, the competition map, the product map, who is doing what transactions are taking place, who is in the market, and what the potential valuations are. Competition, again, what players, competitors are doing. Are they buying or they're starting greenfield operations? You need to test that. And finally, the most important thing. It's not really that important. Of course, you have to do the valuation, but in the end, it's not the valuation that makes the transaction. It's the price. It's the price that you strike the deal. Of course, after you've done it, you can go back to Excel. One side will say, I overpaid. The other side will say, I didn't get as much as I expected. The key ingredient of a good transaction is that brackets between what I expected, what I got as a money, or what I had to pay to get the company is not too large. So both sides think that they have achieved a satisfactory transaction for both sides. Now, let's see what can go right with the transaction. Management and compliance. Usually we help the owners, as I said before, to professionalize the company, strengthen the team, improve the management systems, help them even to deal with things like ESG and Green Deal. Generally, when we leave, we like to say that we're leaving behind a better company, a better business. In value creation, we will take a higher risk on the proposed value creation because we have to trust the management, again, the human factor, and we will do it with a higher level of risk than any bank or any IPO would ever take for that price, because usually then they will discount the level of risk by offering a lower price. And finally, a partnership. If we strike the right chord, the human factor between the investor and the owners and the managers, then we are on good way to a good cooperation based on good agreements. That's what can go right. Now, what can go wrong? Lack of full disclosure. If an entrepreneur decides not to show the full information to the investor, then we're all in problem. And that is why I insist we should have professional advisors that should do full due diligence of the market, industry, services. Very important. Human resources, even more important in case of family businesses, the family links to the business, and all other, let's call it, soft factors. Unreasonable price expectations, as I say, that can be mitigated, but you may also design the way that the price, if you feel an investor that the price asked is being too high, you say, okay, I will pay 90% of what you want to get now. If we do together the first budget, the way you think you will do it, I will pay the additional 10%. If you don't do the budget as you expect, you fall below the budget, then I paid 90% and that's it. Believe me, it's a very good solution. I had 2 or 3 times this case, and in one case, my entrepreneur fought very strong to get a better price. When at the end of the next year, he realized that he will not have the budget done, we didn't even address the issue of a second payment of the payment. It was obvious in the financial results that we paid the right price. The 90% suddenly became 100%. Now, anti-competing compliance, as I mentioned before, smaller businesses may require more work in terms of the management and corporate governance, business implementation. It takes more time. It is more expensive for the investor. That is very often the reason why private equity funds do not invest below certain level of investment, because the fixed costs is going to be the same. The team time will be the same, and the growth potential will be smaller in absolute terms because you're investing in a smaller business. Now, let me quote you 4 lessons from a real expert. I do recommend to everybody to read How to Invest by David Rubinstein, who is the original founder of Carlyle Group. And he did an interview in this book with Sandra Horbach, who actually is a partner also now with the Carlyle Group. And Sandra made 4 very interesting observations with which I absolutely agree. The first key success for both entrepreneur and the private equity manager is be humble, okay? Do not think that you know everything. Do not try to convince everybody that you know everything. You have to accept diversity of opinions when making an investment decision, okay? Others may know better. Of course, if you do not convince them, ask all the tough questions for you to convince you. In our fund and in most funds, we have on the investment committee unanimous decision principle. If we 4 and my colleagues do not convince me, I don't vote for. They have to convince me. If there is 1 vote again, we simply don't do this transaction. It's a professional respect and also the professional sharing of the risk. Because if we do a transaction and it doesn't work out okay, it's also my blame. I cannot say I wasn't voting for it. Yes, I did for it. I accepted potential upside. I also accepted potential downfall. So I have to be responsible for that. Second thing, you have to be a good reader of people, because we are investing other people money. And very often, in case of fund of funds or family offices, these money have been entrusted with them by other people. So it's basically passing on down the line the trust of other people that you know what you will do with their money. Very important point. Always try to drive the change, to coach the management, to look outside, because complacency is something that kills the organization. If everybody thinks that what we have is okay and we're doing okay, there's always a competitor who will drive past you at full speed and will be very difficult to get up to his speed. So always try to be on the outlook, looking for new things, new ideas. And the last thing, it also kind of links into being humble. Do accept failure. Nobody's perfect. Everybody makes mistakes. And only very few people are able to admit to their mistakes, learn from them, and continue their work. Now, The corporate world and private equity are full of people who say, I know better, but when the problem starts, they will always look for excuses to blame others for the problem. Be brave to simply say that it might have been your mistake too. Now, I have this picture hanging in my office. Do note that there's dark outside. So the best and most interesting negotiations I lived through usually happen overnight. A couple of reasons. Reason number one, your portable phone doesn't ring, you don't look at the email, and basically nobody knocks on the door saying that there's somebody who would like to see you. So we fully focused and concentrated on negotiations. The second thing is, if we want to change something, we can break the negotiations, we can ask our financial advisors, accountants, lawyers to do additional calculations, to redraft the arguments or the articles in the agreement. It happened to me to negotiate 2 or 3 nights in a row, because in one case, a lawyer forgot one important piece of paper somewhere in the world, and we simply had to wait the whole night and the next day for the document to arrive. And obviously that has changed the date of the contract being signed. As you can imagine, in this case, we had like 14 copies of the 150 pages of SPA. So change the proper date in such a document, it does take the whole day to do it. Now, once you've done the transaction, the second thing starts is what we call keeping an eye on the ball. You entrusted your money with new people. You believe in what they want to do it. Your role now is to monitor the organization, is to, as you agreed with the entrepreneur, to put in all the new reporting and monitoring and KPI, whatever you agreed on, factors, the budget, the organization structure, the top staff responsibilities, the way how the supervisory boards meet, how often, all these things. Second, you have to, from the very beginning, do the 5-year roadmap and decide on how you're going to motivate your management with bonuses, with shadow stock, with carried participation, whatever. Especially if you, as the financial investor, you will be selling your management to another owner. They have to be motivated and they must agree that they will be rewarded in part for the return you're making on selling your shares. Now, monitoring the management, again, the monthly, quarterly portfolio reporting, this is something we have to do for our investors. So we must be in a seamless sync with the management of the company, that they must understand why we asking for the numbers, because we are being asked for the same numbers by people, so to speak, upstairs. And finally, as I said before, we do not create value as investors. We monitor creating value. We coach how to create the value. We may help. We may have suggestions. We may put our entrepreneurs in touch with the right people, which we very often do. But ultimately, it's the management of the company that creates the value, and it's the management of the company that should be rewarded for it. Now, the expectations of investors are a bit different, okay? First of all, we expect the management team will perform as promised. And of course, there's long list of things from financial targets, KPIs, down to ESG and sustainability. We'll expect that the performance monitoring and financial reporting is absolutely in place. As I mentioned, the value creation is the process, and we want to be part of it. And finally, the exit of our investment starts the day we invested. It's an ongoing process, because you never know who at what stage will come to you and say, I like the business you're building. I would like to make you an offer now. Now, don't forget about other stakeholders. As I mentioned before, the management, they want to be in a company that provides them with professional development. They, of course, expect better remuneration. And as I mentioned, participation, value creation, they want to be part of it. Now, there are other stakeholders, the staff, the customers, the community, that expect a better corporate citizen, a better company. And of course, the owners, the original owners of the business, value creation, the perennity of the business, and also the status that they build something which will outlast them. Now, one word of advice when controlling the company, monitoring, please do not try to control everything, because if you try to set too many rules, actually it will be detrimental to value creation. So do certain checks, especially in smaller companies, in soft human way. Do not try to put much procedure in. This is actually the slide I showed my team in the very beginning when we started the fund. I like it very much. In Polish, it says, who is going to row? Okay. As you can see, there are 4 leaders. Everyone wants to steer the boat, but nobody's really prepared to contribute to pushing the boat ahead. Now, that is very important thing. In any transaction, every side, members of the investment team, members of the management, the owners, everyone has to take responsibility for others and for his place, his job in this transaction. Now, as we said before, be humble, be stern, convince, but do not impose. Ask and understand before you vote. Once you vote, you carry a responsibility. Now, supervisory board, even in a very small company, can be a fantastic sounding board for putting all these different and diverse interest stakes together. The fund, entrepreneur, they will act under shareholders agreement, but very often they need a place to discuss. That's why it's very essential whom you nominate to represent you in a supervisory board. Now, does it make sense to invite independent board members? Well, depending on the stake you have. But from my experience, even if you have the business 50-50, it always helps to have a third voice, an independent advice. So I do recommend taking an independent board member. Now, I think the most important thing the board can do in such a situation is to help to evaluate and to mitigate the risk factors, both external, because even if we do not control what's happening in macroeconomic situation or geopolitical situation, it's good to know how this will affect the business and what's our plan B, how we should react. In case of internal problems, the board can be absolutely independent, neutral arbiter between the management, the investors, the owners, the staffers, the trade unions. So this is not a role to be not considered, not seen. Now, to finish, I can only tell you that a well-designed transaction, as difficult as may seem, will definitely lead to one thing. It will lead to building a successful company that will deliver value to you as investor or as entrepreneur, to everybody considered. So if you are down this road, either as entrepreneur or as investor, I do wish you that every presentation you make finishes with a similar slide. Thank you very much for your attention. Now, if you have any questions, I'm here for you. I'm looking at the chat. Okay. I see no questions. It might be a good sign or the bad sign. So I will not make a judgment here. If there are no questions coming, listen, everyone, thank you very much for giving me this half an hour to share some ideas, some experience on how to design a good financial transaction. Matthew, thank you very much. Interesting talk. Thank you. Thank you for listening. Host and panelists, thank you very much. If you have any other questions, thank you. Thank you. All right. Thank you for listening. Thank you for everyone. Goodbye.